Jersey Mike's Subs Inc. Pre-IPO Analytical Report. America's #2 sub sandwich brand heads to the public market. Section 1. Executive Summary. Jersey Mike's Subs Inc. is a fast casual submarine sandwich franchisor headquartered in Tinton Falls, New Jersey, that is filed to go public on the New York Stock Exchange under the expected ticker JMKE. As of this report's date, July 21, 2026, the company is not yet publicly traded. The roadshow launched on July 20, 2026, and trading is expected to begin around July 30, 2026, subject to market conditions. In plain terms, Jersey Mike's is the second largest sub-sandwich brand in the United States behind Subway, operates on an almost entirely 99% franchise model, and earns money primarily through royalties, 6.5% of each store's gross sales, and advertising fund contributions, 5.0%. This makes the corporate-level business extremely high margin and capital light. Despite $724 million of revenue in 2025, net income was $55 million, and adjusted EBITDA reached $339 million, a roughly 47% margin. The company is majority owned by private equity firm Blackstone, which acquired a controlling stake in November 2024 at a roughly $8 billion valuation. Following the IPO, Blackstone will retain voting control through a dual-class share structure, meaning Jersey Mike's will formally remain a controlled company under NYSE listing rules. Key facts at a glance. Business model, franchising of sub-sandwich restaurants, approximately 99% franchised, approximately 1% company-operated. Store count, 3,256 at FY 2025 year-end, approximately 3,300 as of July 2026. Across all 50 U.S. states plus Canada. FY 2025 revenue, $724 million, up 11% year-over-year. FY 2025 net income, $55 million, up from $5 million in 2024. FY 2025 adjusted EBITDA, $339 million, approximately 47% margin. Total debt, approximately $2.1 to $2.2 billion via whole business securitization through the Series 2026 1 notes. Controlling shareholder, Blackstone Inc., majority owner since November 2024. This report is intended to give a clear, fact-based view of Jersey Mike's business, the structure of its planned IPO, and the key risks and catalysts ahead of and following its public listing. It is not a recommendation to buy, sell, or hold JMKE shares. Section 2. Company Overview. Legal entity. Jersey Mike's Subs Inc. Headquarters, Tinton Falls, New Jersey, historically headquartered in Manasquan, New Jersey. Exchange and ticker, NYSE, JMKE, expected. Year founded 1956 as Mike's Subs, acquired by Peter Cancro in 1975. Franchising began 1987. Founder and Executive Chairman Peter Cancro. Chief Executive Officer Charlie Morrison since April 2025. Majority owner, Blackstone Inc., since November 2024. Store count, 3,256, at FY 2025 year-end. Approximately 99% franchised. Corporate milestones. 1956, original shop founded as Mike's Subs in Point Pleasant, New Jersey. 1971 to 1975, 17-year-old Peter Cancro begins working at the shop, then buys it outright. 1987, company begins selling franchises under the Jersey Mike's brand. 2020 to 2025, 20th consecutive year of positive same-store sales growth. Cumulative positive 50% growth over the period. November 2024, Blackstone acquires a majority stake at a valuation of roughly $8 billion. April 2025, Charlie Morrison, former CEO of Wingstop and Salad & Go, named new CEO. Peter Cancro remains executive chairman. January 2026, franchise agreement signed for up to 400 stores in the UK and Ireland, personally led by Cancro through JM Submarines UK Limited. Early 2026, company raises approximately $760 million via whole business securitization. A portion of proceeds funds a dividend to shareholders, including Blackstone. July 2, 2026, Form S-1 publicly filed with the SEC. July 20th, 2026, Form S-1A filed. IPO price range of $21 to $25 announced. Roadshow begins. Approximately July 30th, 2026. Planned trading debut on the NYSE under ticker JMKE. Section 3 Products and Services. Jersey Mike's sells made-to-order submarine sandwiches built on freshly sliced meats and cheeses. The brand positions itself at the premium end of the sandwich category, emphasizing recipe authenticity and ingredient quality, a factor the company itself cites as its key point of differentiation against Subway. Store formats. Jersey Mike's locations are predominantly inline and end-cap units in strip malls and shopping centers, historically averaging around 1,500 square feet. New builds now target a smaller 1,200 to 1,400 square foot footprint, reducing construction costs. The brand is also present in non-traditional venues such as airports, college campuses, and stadiums. How the company itself makes money, not the individual store. It's important to distinguish between the individual restaurant and Jersey Mike's Subs Inc., the company going public. An individual store sells sandwiches to customers, but the parent company is a franchisor. It doesn't make money from selling sandwiches directly. Instead, it earns royalties, 6.5% of each franchise store's gross sales. Advertising fund contributions, 5.0% of gross sales, reinvested into brand marketing. Franchise fees, one-time payments collected when new stores open. Together, royalties and related revenue totaled $483 million in 2025, up 11% year over year, the company's primary revenue source. This structure is exactly why the corporate-level margin is so high. The company bears almost none of the construction, equipment, or staffing costs of individual stores. That responsibility falls entirely on franchise owners. How to think about it. Less as a chain of sandwich shops and more as a brand landlord. It licenses its name, recipes, and operating system to independent business owners, and in exchange collects a small but steady cut of every dollar rung up across thousands of stores nationwide. Section 4. Business Model. Jersey Mike's runs a classic asset-light franchising model, similar in structure to McDonald's or Domino's Pizza. The company owns and operates only a small fraction of stores directly, instead selling the rights to use its brand, recipes, and operating system to independent franchise owners who fund their own construction, equipment, and staffing. Franchisee unit economics for FY 2025. Average unit volume, approximately $1.4 million. Store-level margin after royalty and advertising fees, approximately 16%. Average build cost, approximately $515,000. Sales to investment ratio, 2.6 times. Cash-on-cash return, approximately 42%. Payback period, 3 to 5 years, median. Total fee burden, 11.5% of gross sales, 6.5% royalty plus 5.0% advertising. In plain terms, a franchisee investing in a Jersey Mike's store puts in roughly $515,000 on average, then owns a store generating approximately $1.4 million in annual sales at about a 16% margin after paying fees to the parent company, implying payback in roughly 3 to 5 years, a strong result by restaurant industry standards. Why this matters for the parent company? Because franchisees fund their own new store openings. Growing the system requires almost no capital from Jersey Mike's Subs Inc. itself. In 2025, the company's own capital expenditures were just $11 million against $339 million of adjusted EBITDA, meaning it converts roughly 97% of its adjusted EBITDA into free cash flow, when measuring adjusted EBITDA, less capital expenditures of $328 million. Section 5. Industry and Market Analysis. Jersey Mike's competes in the fast casual restaurant segment, specifically the sub and sandwich QSR niche, one of the most saturated categories in the U.S. restaurant industry. Over the past several years, nearly every major player in this niche has come under large private equity or corporate ownership. Subway was acquired by Roark Capital in 2023 at approximately $9.6 billion. Jersey Mike's by Blackstone in 2024 at approximately $8 billion. And Firehouse Subs is owned by Restaurant Brands International. Jersey Mike's system-wide sales reached $4.2 to $4.3 billion in 2025, up roughly 13% year over year. This growth has come predominantly from new store openings rather than higher sales at existing locations, a dynamic explored further in later sections. Competitive positioning. On average unit volume, the key measure of how much an individual store sells per year, Jersey Mike's meaningfully outpaces its direct competitors. Roughly $1.4 million versus approximately $490,000 for Subway, approximately $986,000 for Jimmy John's, and approximately $964,000 for Firehouse Subs. 2024 figures. This means the average Jersey Mike store generates nearly 3 times the sales of an average Subway location. Footprint of over 20,000 locations, dwarfing Jersey Mike's approximately 3,300. Market trends. Consumers increasingly favor fast casual concepts with fresh and premium ingredients over traditional fast food. Subway's prolonged brand crisis, including mass store closures, controversies, and quality concerns, has opened market share opportunities for competitors. Growing adoption of digital ordering, delivery, and loyalty programs across the category. International expansion into the UK, Ireland, and Canada represents a new growth avenue for a brand that has historically been almost exclusively North American. Section 6. Financial Analysis. Key Metrics by Year. FY 2023. Revenue, $561 million. Net income, information not publicly available in this source set. Same-store sales growth, positive 8.4%. Net new store growth, approximately 12%. FY 2024. Revenue, $653 million. Revenue growth year over year, positive 16.4%. Net income, $5 million. Same-store sales growth, positive 2.0%. Net new store growth, approximately 12%. FY 2025, revenue, $724 million. Revenue growth year over year, positive 11%. Net income, $55 million. Same-store sales growth, positive 3.2%. Net new store growth, positive 8.5%. In plain terms, revenue has grown at a double-digit clip for several consecutive years, and net income jumped sharply in 2025, largely because following the Blackstone acquisition, the company stripped out substantial founder-related discretionary expenses, including discretionary bonuses and charitable donations at Peter Cancrow's personal discretion, which had previously depressed reported profit. This means part of 2025's margin improvement is an accounting effect, the disappearance of one-time expenses, rather than purely a change in underlying store-level economics. Same-store sales trend, what to watch. The single most important metric for any franchise system is same-store sales. Sales growth at stores open for at least a year, which strips out the effect of new openings. Jersey Mike's SSS growth has been decelerating. Positive 8.4% in 2023, a sharp drop to positive 2.0% in 2024, a partial recovery to positive 3.2% in 2025, but the year ended at just positive 0.5% in the fourth quarter, followed by positive 1.7% in the first quarter of 2026. This means the bulk of the system's overall growth is currently being driven by new store openings rather than rising sales at existing locations. Debt load. As of March 29, 2026, total company debt stood at approximately $2.12 billion, raised through a whole business securitization, a structure in which the company pledges future royalty payments, its trademark, and its franchise agreements as collateral to issue bonds, the Series 2026-1 notes, at rates of 2.5% to 5.6%. This is estimated to cost the company roughly $90 million of net interest expense annually. A portion of this borrowing, approximately $760 million raised in early 2026, did not fund business growth, but instead financed a shareholder dividend, including to Blackstone, with financial media estimating roughly $500 million of dividends paid out before the S-1 was even filed. Section 7. IPO Details. Public S-1 filing date July 2, 2026. S-1A filing with price range July 20, 2026. Expected NYSE trading debut approximately July 30, 2026 per market estimates, not confirmed by the company. Price range $21 to $25 per share. Total shares in the offering 43,478,261 shares of Class A common stock, of which sold by the company 13,782,609 shares, new issuance, of which sold by existing stockholders 29,695,652 shares, approximately 68% of the offering, including 26.3 million shares from Blackstone and 3.3 million from the Abu Dhabi Investment Authority. Underwriters over-allotment option, up to 6,521,739 additional shares within 30 days. Expected gross proceeds, up to approximately $1.09 billion at the top of the range. Expected valuation, up to approximately $7.9 to $8 billion at the top of the range, based on shares outstanding. Share structure, dual class, Class A and Class B. Blackstone will retain voting control. NYSE listing status, controlled company. Blackstone will hold a majority of voting power. Underwriters, global coordinators and joint book-running managers include Morgan Stanley, Jefferies, and JP Morgan. Co-global coordinators are Barclays and Guggenheim Securities. The broader underwriting syndicate includes Goldman Sachs, Evercore ISI, UBS, Baird, Wells Fargo, William Blair, RBC Capital Markets, Deutsche Bank, Nomura, Piper Sandler, and others. Use of proceeds, at the midpoint of the range, $23 per share. The company itself would receive approximately $301 million of net proceeds. Of that, the company plans to use approximately $295 million to partially repay the Series 2026-1 notes, that is, to reduce debt. The remainder of the total offering, a substantially larger amount, will not go to the company, but to existing stockholders who are selling shares, primarily Blackstone. Note, some independent financial analysts have referenced a higher valuation figure, up to approximately $12 billion, based on a different methodology that incorporates the company's debt into an enterprise value framework. The official price range disclosed in the S-1A, multiplied by post-offering shares outstanding, implies a valuation closer to $7.9 to $8 billion. This figure takes priority, as it is derived directly from the company's SEC filings. Section 8. Competitive Analysis. Subway, owned by Roark Capital since 2023 at approximately $9.6 billion. The largest U.S. sub-chain with over 20,000 locations, but a much lower average unit volume of approximately $490,000 and ongoing brand and quality challenges. Firehouse Subs, owned by Restaurant Brands International, a public company trading on NYSE under the ticker 2SR. Average unit volume approximately $964,000 as of 2024, part of RBI's larger multi-brand portfolio alongside Burger King, Popeyes, and Tim Hortons. Jimmy John's, owned by Inspire Brands, a private company. Average unit volume approximately $986,000 as of 2024, focused on fast delivery. Potbelly Corp., a smaller chain focused on toasted sandwiches, publicly traded on NASDAQ under the ticker PBPB. Useful as a comparable multiple benchmark. Panera Bread, part of a larger public portfolio, broader fast casual category with partial audience overlap. Capriati's and Arby's, smaller direct and adjacent competitors in the sandwich niche. Jersey Mike's competitive advantage. The company's key competitive edge is the highest average unit volume among major sandwich chains, approximately $1.4 million, directly signaling stronger unit-level economics than its competitors. This is highly attractive to prospective franchise investors, sustaining a steady pipeline of new store applications, even as same-store sales growth slows. At the same time, it's worth noting that nearly all major competitors in this niche have come under large investment fund ownership over the past few years, meaning competition for real estate, labor, and marketing budgets will increasingly be fought between well-capitalized players rather than small independent chains. Section 9. Management Team. Charlie Morrison, Chief Executive Officer, since April 2025. Role: CEO of Jersey Mike's Subs Inc. since April 28, 2025. Succeeding founder Peter Cancro. Prior experience: CEO of Salad & Go, immediately before joining Jersey Mike's. Earlier, Chairman and CEO of Wingstop on NASDAQ. Key achievements: during his roughly decade-long tenure at Wingstop, the chain's store count quadrupled, and its average unit volume doubled. Salad & Go also saw significant expansion under his leadership. Stated priorities at Jersey Mike's: accelerating growth in new and existing markets, and continued investment in technology and innovation, including a pilot with SoundHound for automated phone order-taking technology. Peter Cancro, Founder and Executive Chairman of the Board. Role: Executive Chairman of the Board, company founder. Background: began working at the original Mike's Sub Shop in 1971 as a high school student. bought the shop outright in 1975 at age 17, began franchising the brand in 1987, served as CEO for approximately 50 years, through April 2025. Current role, remains executive chairman and a significant minority shareholder, following the sale of a majority stake to Blackstone. Personally leads the brand's international expansion into the UK and Ireland through JM Submarines UK Limited. Hoyt Jones, President. Prior experience. Previously held senior leadership roles at Domino's Pizza. Additional achievement detail in this specific role, information not publicly available in the sources used for this report. Governance and control. Following the IPO, the company will have a dual-class share structure, under which Blackstone, through affiliated entities, will hold a majority of voting power at shareholder meetings. As a result, Jersey Mike's Subs Inc. will formally qualify as a controlled company under NYSE listing rules, which exempts it from certain standard corporate governance requirements applicable to typical public companies, such as specific board committee composition rules. Section 10, Key Risks, Significant Debt Load, roughly $2.1 to $2.2 billion of debt via whole business securitization at rates of 2.5% to 5.6%, with estimated net interest expense of approximately $90 million per year. This meaningfully constrains financial flexibility, particularly given that a large share of the borrowing funded shareholder dividends rather than business growth. Decelerating same-store sales. SSS growth slowed from positive 8.4% in 2023 to positive 3.2% in 2025, exiting the year at just positive 0.5% in Q4 2025. This means the vast majority of the system's overall growth is now being driven by new store openings rather than organic demand at existing locations. Slowing unit growth. Net new store growth was positive 8.5% in 2025, down from roughly 12% in prior years. The company attributes this to a 2024 development pause tied to the Blackstone sale process. Blackstone control and dual-class structure. Public shareholders will have limited influence over major corporate decisions since Blackstone will retain voting control. Controlled company status also relaxes standard governance requirements, otherwise mandatory for public companies. Related party payments to the founder's family. The prospectus discloses significant payments to Peter Cancro's family members. Approximately $50.5 million to his stepson from 2023 to 2025, more than $31 million to his brother-in-law from 2024 to 2025, and roughly $21 million to his brother John Cancro from 2023 to 2025. Related party transactions of this scale typically draw heightened scrutiny from institutional investors and regulators. Rich valuation relative to peer multiples. Independent financial analysts estimate the planned IPO valuation implies roughly 39 to 41 times trailing 12-month adjusted EBITDA, well above mature franchise peers such as Domino's at approximately 18 times, and comparable to or above Wingstop at approximately 23 to 25 times, with Wingstop shares down roughly 65% from their peak following negative U.S. same-store sales. Dependence on franchisee economics. Company revenue depends directly on the financial health of thousands of independent franchise owners. A deterioration in unit-level economics, from cost inflation, competition, or softer traffic, can simultaneously hurt both new store development and royalty collection. Intense competition in a saturated category. Nearly all major competitors, Subway, Firehouse Subs, Jimmy John's, are now well capitalized through their own private equity or corporate ownership deals, intensifying competition for real estate, labor, and consumers. Relatively new CEO, Charlie Morrison has led the company only since April 2025. Despite a strong track record at Wingstop and Salad & Go, he does not yet have an extended results history, specifically at Jersey Mike's. IPO process risk. As of this report's date, final pricing, timing, and terms of the IPO have not been confirmed and remain subject to change based on market demand and broader IPO market conditions. Section 11. Potential post-IPO growth catalysts, successful NYSE debut, completion of the roadshow, final pricing, and the start of trading, expected around July 30, 2026, will provide the first real test of market demand for the stock. First quarterly report as a public company. The first post-IPO earnings report will give investors an initial read on whether same-store sales continue recovering from positive 1.7% in Q1 2026, toward management's internally disclosed approximately positive 2.3% quarterly target. Exact date not publicly available. UK and Ireland expansion. First London stores are expected later in 2026 under a deal for up to 400 locations, personally led by founder Peter Cancro, the brand's first major push beyond North America. Canada expansion. The company has announced plans for up to 300 stores in Canada by 2034. Execution against a 1,600-plus store development pipeline. The company already has signed agreements for more than 1,600 additional U.S. locations. Executing this pipeline is the primary driver of future system-wide sales growth. Debt reduction using IPO proceeds. Approximately $295 million of offering proceeds are earmarked to partially repay the Series 2026 1 notes, which would modestly lower the company's future interest expense. Potential traffic recovery at existing stores. If the SSS improvement trend seen in Q1 2026, positive 1.7%, continues, it would signal that the 2024 to 2025 slowdown was cyclical rather than structural. Section 12. Conclusion. Jersey Mike's Subs Inc. is going public as a profitable, well-known and fast-growing franchise system, with the highest average unit volume of any major U.S. sandwich brand. Its business model, a classic capital-light franchising system with a high margin of approximately 47% adjusted EBITDA and minimal capital spending of $11 million in 2025, is in theory attractive to investors seeking stable, predictable cash flows. At the same time, prospective investors should weigh three specific concerns. First, a significant $2.1 to $2.2 billion debt load, part of which financed shareholder dividends before the IPO rather than business growth. Second, a notable slowdown in organic same-store sales growth, from positive 8.4% in 2023 to just positive 0.5% in the fourth quarter of 2025. And third, a dual-class share structure that leaves control with Blackstone and limits public shareholders' influence over the company. Bottom line, Jersey Mike's represents a story of strong brand equity and proven franchisee unit economics, coming to the public market at a valuation that, per independent analyst estimates, implies a fairly premium multiple relative to mature franchise peers. The success of the investment will depend heavily on whether the new management team, led by Charlie Morrison, can re-accelerate same-store sales growth while continuing to open new stores at pace. This report does not constitute a recommendation to buy, sell, or hold JMKE shares. Readers should review the complete Form S-1A on SEC EDGAR and consult a qualified financial advisor before making any investment decision.